But time to go to our fundamental expert as well. We're joined by Jigar Mistry of Quint Capital, who joins us right here in the studios. Hi, Jigar. Good to have you with us. I think it's your first show with us, so welcome to Bloomberg Quint. What's been the assessment so far with regard to earnings season? I think largely leaving aside private banks, which disappointed on slippages front, but numbers looks like they've been in line with what the street has been expecting.
Yeah, first show, so thank you so much for inviting me. You're right, Navneet, that essentially the third quarter so far has, going into it, we were looking at fairly subdued sort of expectations, but I think those have more or less been in line. I think the sort of thoughts are moving away from the quarter and more into what the budget can deliver now.
Correct.
And you know, if I had to say, I think one has to keep a very restrained view on what can be achieved, right? So essentially, if you look at where we are right now, we have already reached the fiscal deficit between April and November of something like 8 trillion rupees, and versus a budgeted number of 7 trillion rupees. Now, historically, the full year fiscal deficit is lesser than the first 8-9 months because the tax collections pick up and then the government breaks down on expenditure. But this time around, we are dealing with almost 1.45 trillion of tax cuts. So one needs to see on where the GFD number would end up at. My sense is 7.8 to 8 trillion. And that's just the numerator, right? The denominator, which is the nominal GDP, will itself be lower from something like 211 trillion expectation to 205. So you're looking already at 3.7, 3.8 gross fiscal deficit to nominal GDP, and the 3.3 was the expected number. Now, where do we go from here? I think it's a question of credibility to a certain extent, because we are likely to miss the tax collection mark by almost 2 trillion rupees at the center's level. So that's like 1% of GDP. That's not small. And if we budget it right, then we'll be looking at FY21 from a revenue standpoint, which is equivalent to FY20, which is roughly 23-24 trillion. And that would still, if expenses are still growing at the nominal rate of inflation, so we're looking at gross fiscal deficits of something like 8.5 plus, which will still get you to 3.8, right? So the question isn't what gives, right? The question is how to allocate it.
Correct.
And the question, if I'm asking myself, is essentially that, let's say, the key decisions will break it down to three fronts. One is whether to expand or consolidate on a fiscal standpoint. The second question is, if you consolidate, then whether you increase expenditure or give income tax relief. And the third essentially is that if all of that doesn't work out, whether you stimulate the rural or the urban economies, right? Now, the government spending was something that is entirely driving the 2Q GDP, 15.5% versus 4.5%. So now you can't slow down on that. And whether to stimulate urban versus rural, you essentially have to take a call. I think the inflation is very good news and something that needs to sustain. The reflation of economy is a great thing to have happened, and I think that's where we are taking our cues from.
So let's assume it's not capital side but revenue driven. The question is then, therefore, does that stimulate the volume growth numbers for some of these consumption names? I'm just trying to link it back to the markets crudely. Now, we've seen what's happened this time around. The volume growth numbers have looked very, very iffy. Colgate just released 2.3. Dabur domestic was 5.3 odd, and that was reasonably okay. But different companies are giving out very different displays of what Q3 held for them on volumes. What do you think could happen over the next 12 months with or without whatever the FM does in the budget?
I think the road to recovery is not going to be a V shape, right? 4.5% real GDP growth. If you look at private consumption, that was up 5%. Government spending was up 15%, and everything else was zero or negative.
Sure.
So from there, you can't really expect something to return a positive volume growth territory. Now, what can bring this back? I think what many of the commentators are missing is the fact that what 7.35% handle on inflation means, right? The food beverage CPI was 12.2% and non-core was 3.6%. So vegetables growing at 60%, the wholesale price of milk going from 22 to 30, milk itself is a 8 trillion market. So putting 4 lakh crores in the hand of farmers. that will go to a certain extent a decent way. I don't think we should expect personal tax cuts, because if you look at the RBI paper, then the state spending in terms of fiscal multiplier outweighs central spending, which outweighs taxes.
Yeah.
So I think if it's given a choice, I would much rather push with expenditure rather than cut taxes.
So then, therefore, it brings out the question that what happens to the volume growth numbers for all of these consumption names, and whether it's a pocket, staples and discretionary is a pocket that's worth investing in.
Investing is two-pronged question. So I think neither space is worth investing in today. Right, because if you look at the discretionaries, I cannot talk of discretionaries without a caveat. Right, talk of automobiles, for example. Yes, the rural farm incomes this year, in our expectation, with the expectation of Rabi, will be the best in 4 years. But can I go ahead and say, yeah, two-wheeler will not have any impact from EVs? Probably not. Right, and whether let's say white good will not see the brunt of the crunch of demand, I don't think so. I think this whole question arises because over the last 2 years we have had this investment theme where what's doing good continues to keep doing good, right? But whenever you have seen the spreads compress, so when you look at the corporate spreads compress, investment styles have to change, right? No PE, no stock in India is a 1000 PE stock. So one strategy that has worked over the last 2 years is unlikely to work going forward. 2018-19, I'll tell you, is been one of the most trying times in terms of credit markets. The upgrades to downgrades, if you look at the CRISIL website, is something like 2:1, right? In 2020, it's come down to 1.2:1. We're still not seeing more upgrades than downgrades, but the corporate spreads are reducing. So it's not come down as much as 135 BIP repo correction, but the spreads are reducing for a AAA paper, for a AA paper, not so much for BB and below. Once that start crunching down, you will see the markets broad base, right? And you've seen that. So from 19th September, you've seen more stocks outperforming BSE 500. Over the last 1 month, 70% stocks, so 350 stocks have outperformed BSE 500. You compare that number for 2018-2019.
Much
top
different.
5 companies are up 57%. The bottom 200 companies are down 50%. So I think there has to be a U-turn in terms of how investors approach the investments going forward vis-a-vis what it has been over the last 2 years.
Yeah, but Navneet, speaking of what the consumption pack is doing, I think Jubilant Foodwork, how did you guess
Just looking at the stock.
that stock has done remarkably well today, 1831.
Yeah, and I think that's what we were mentioning yesterday. Most of the stocks had already run up so much, and the same-store sales growth number that they have posted, it was the second quarter of outperformance in sequential basis in a slowdown environment that we've been talking about, and probably that's the reason. In fact, a couple of brokerages too this morning, they've increased the target price on Jubilant Foodworks. Aditya, it's now at 52-week high, 1830. Would you advise to cover longs, or one should stay put and expect higher levels from here on as well?
It's a tough question to answer, Navneet, because till yesterday it was looking it's going to break down because there was back-to-back 2 days of weakness as far as Jubilant Foodworks was concerned. Today it's back up again, making new 52-week highs. I will prefer to book out profits at current levels. Closer to about 1850 is a resistance for the stock. So I would prefer booking out profits if somebody is already holding on to longs. Would not recommend advising fresh longs. Probably on declines to levels of 1750, one can again look to initiate fresh longs, but not at current levels. If you're holding long, it's prudent to book out profits at current levels.
Yep, and the other one, I think your top F&O gainer is Escorts, we've been highlighting, and that's going from strength to strength here. Kunal, on the charts, I guess it's just 3 or 4% away from its 52-week high levels. 808 now on Escorts. A lot of long positions are coming by even at current levels. What would you advise doing on Escorts now?
So again, Navneet, if you look at the weekly chart, there was a big spike right from 700 to around 808. So that's staggering around 14% in a week itself, and because of good numbers, definitely there is more buying interest. But right now the stock is near to September, that's March 2019 level, which is near to 820, 830 mark. So we may see some kind of cooling off from this levels. If these levels are taken out decisively on the higher side on weekly basis, weekly closing basis, then I think there is more potential on the higher side till say 920, 930 mark. If you're already holding the counter, advisable to trail the stop loss and keep the stop loss for time being to say 750. Fresh entry I would avoid at this level because of extreme risk reward ratio.
Jigar, the QSRs, I mean, I know you mentioned that staples is not a great pocket, but QSRs and the same store sales growth that the two listed ones have shown, do you like them?
Absolutely, yeah. I think QSR essentially is a interesting space to be in. We don't hold that in the portfolio as of now.
Neither of the two.
Neither of them we own in the portfolio because the portfolio is slightly differently structured at the moment. But everybody is seeing eating pizza apparently, right? So the same store sales growth is growing. Revenue growth was at about 9%, so it's turning out to be fantastically well. One of the select few pockets where if they're happy to show growth, I think markets is happy to reward them. Escorts on the other hand is I think a play pretty much on how rural farm incomes, right? So tractors is a space which is pure play rural. M&M you might not get from the perspective that there are a lot of other businesses, so rural per se is not a large part of SOTP, but Escorts is a very interesting play as well. We don't own that in the portfolio either, but it's an interesting space to be in.
Why don't you discuss the stocks which are there in the portfolio? A couple of them.
Lots of them actually. So I think we can break it down in terms of how some sectors are loud and some sectors have not been over the last 2 years. Our strategy is either to get into them because the investment strategy needs to change, and even within the spaces that are doing very well, there are stocks that have not. So for example, the sectors we like a lot are banks. We have ICICI and HDFC. Historically we have owned Axis, we have owned IndusInd Bank, but we don't have that anymore. One large part of the play is valuations. The other part of the play is that if rural incomes are going to grow, you need to have a player that have presence in that space. Credit is a market which is very important for us. So whenever the spreads compress, two asset classes do fairly well. One is equities, of course, but others is credit. And if you see, the banking system level liquidity is almost at 3 trillion. Now even assuming $1 trillion for the government year-end numbers, is still sitting on huge surplus liquidity. So banking is one sector that one must have in the portfolio. We have ICICI and HDFC. Insurance has run up a lot. So HDFC Life is trading at 6 times price to embedded value. But whenever you have an HDFC Life, you have a Max Life, which is every bit as good as HDFC Life in terms of operating parameters, but not doing as well because of a few technical issues. So if those issues get addressed, I don't know if that happens in 1 week or a month, but that could give a 50% upside easy, right? So Max Financial is something that we have.
So you would wait for the deal to happen before you believe that Max could actually take a surge upwards? No, not really.
No, because see, once the deal is announced, then you won't be able to buy it. Not for the quantity that we want, but we won't be able to buy it.
Because you think the stock will surge any which ways?
Absolutely. So what is an embedded value? It's like all the policies that HDFC Life has written till date, and whatever money it will make through the life of those policies, you discount it back, that is one embedded value. Right? Investors are willing to pay 6 embedded values to HDFC Life. Meaning that if you buy out HDFC Life in its entirety, you will make money after it grows above 6 times. The same number for Max Life is something like 1.7 times. You compare the ROEV numbers, the breakdown of the portfolio, every bit as good as HDFC. Now, why would Axis not want to have an asset like that? Right? So they will sign, in my opinion. Why would somebody not want to buy out Analjeet Singh's stake? I think that would happen. Will it happen next month? I don't know. Will it happen in the next 1 year? Yes. And if the stock is giving a 50% upside, then I'm happy to hold it for a year.
So it's a long-term bet.
Yeah, absolutely. Okay. All our bets, so to speak, are long-term bets.
Okay, so those were a couple of stocks which Jigar discussed with us, and they are there in the portfolio that they handle. But I also want to pull up CCL products. That stocks moved higher. In fact, it's at the highest point of the day. The volumes are pretty decent there, 6% gains. The exchange data also shows you almost 50% of the traded quantity as of now has been marked for delivery. Kunal, on the chart, CCL products at 221. What is it indicating? Is it poised for further upside?
So no, when it comes to TCS, it's near to all-time high, and the previous high mark was 2260, 2270. So that's a multi-year high. Once it reaches that level and it surpasses that level, then probably this is entering into a new trajectory and a new rally may emerge. But till then, one needs to wait for the long position to get really into the portfolio. I think this counter for time being is again finding some kind of supplies in the market. For time being, 2160, 2155 was a strong support which is taken out decisively. Again on the lower side, expect the counter to reach again back to 2075, 2080. But I'm waiting for the stock to make a all-time high closing, and once that comes in, I think this can be the portfolio stock for next 2 years again.
Okay, we'll watch out for this stock as well. Let's focus now on the broader markets and find out what's made it to Sharad Dubey's list of the Fab 4 stocks of the day. Sharad, good afternoon.
Good afternoon, Neeraj. The first stock is Vaibhav Global. The stock is up more than 7% today, and it's one of the top gainers of the Nifty 500 index. Well, the revenues have increased by almost 10% to almost 563 crore, but there was an EBITDA expansion of almost 130 basis points due to lower manufacturing expenses, and also strong growth was seen in the UK and US markets. Up next is Strides Pharma, which is also up almost 5% after it came out with a stellar group of numbers, with the net profit rising almost 3.6 times to almost 101.7 crore rupees. The regulated markets continued to show traction, but the management did speak about the emerging markets that remains a concern, and the US market showed a growth of almost 62% to almost $66 million. We are talking about Escorts, the next stock, which is up almost 8%. Fresh longs were seen with a high open interest of 61% and volumes trading at almost 8 times its 20-day average. It came out with its results yesterday itself, and the margins surprised the street. And the last stock of the day we are discussing is CCL Products, which is up almost 6%, its highest level seen in almost 3 months. And also yesterday in the bulk deals, it was reported that Norges Bank has actually acquired almost 20 lakh shares. That roughly translate to almost 1.5% stake in the company. Back to you.
Okay, thanks a lot for that, Sharad. So that's a few stocks that you need to monitor. You also need to monitor Dabur India. By the way, Parag Milk Food results on your screen. Keep that at the back of your mind. But Dabur reported a domestic volume growth of 5.6% in the third quarter. Other parameters were largely in line as well. Joining us to talk about the numbers and the quarter gone by and the outlook ahead is Lalit Malik, the CFO of Dabur India. Mr. Malik, good having you. Thanks so much for joining in. And a pretty decent performance on the domestic volume front. Let's start off with that and then get on to the other parameters. What would your thoughts be on the volumes for the quarter gone by, and how is January shaping up?
Well, I think when we look at the volume growth for this quarter in line with the overall industry performance, I think we are very positive compared to the industry, because overall there has been a consumer sentiments slow, and overall seems to be either muted or decline market sentiments. But in that, our 5.6% volume growth is positive, because we have gained market share in almost all the categories except 1 or 2, but we have gained the market share in all the categories. So in the muted market scenario, we have gained the market share through our own activation initiatives and strategy. I think that has been positive as far as quarter 3 is concerned. When we talk on the current, the muted sentiments continue to prevail even in the month of January. So we have not seen any positive trend yet, and liquidity crunch as well as the low consumer sentiments continue to drive the overall market scenario.
Mr. Malik, the biggies for you, which are dominant in the spaces, Chyawanprash as well as juice brands, already high and gaining substantial market share. Is this organized pocket getting more pie of the shelf from the unorganized, or are you actually getting market share from some of your larger organized players as well in these categories?
Well, I think it is both ways. When we look at the Ayurvedic sector, it is also from the branded product competitors as well as unbranded. We are getting the market share. As far as juice category is concerned, I think we are getting more from the branded category, branded competitors. We are getting the share. So I think it is a mixed bag, category over category, where we are getting the unorganized sector conversion into the Dabur brand, as well as from the competitors we are getting it back. One more point I would like to add at that since we are expanding in the rural markets, that is where more unorganized sector is getting converted into Dabur. So that has been the split between rural and urban. As far as urban is concerned, it is more from the branded products we are getting the share.
Mr. Malik, a lot of your peers have also been highlighting how there's a slowdown even in the rural market, which used to grow nearly 1.3 to or maybe higher than that compared to urban markets. That ratio in the last 2 or 3 quarters has been coming down. And you can correct me if I'm wrong. I think last quarter you mentioned for you rural market was better than the urban market. What was the scenario in the December quarter? And if you could tell us what's the on-ground situation now? You've already stated consumer sentiment is still weak, but are you seeing any green shoots going ahead?
Well, as far as our current quarter is concerned, quarter 3, on the rural side, we have gained growth better than the urban. So our trend continues, and primarily on account of the fact that we have expanded our reach to villages. When in the beginning of the year we were around 44,000 villages, we have now reached to 51,500 villages, and our target is to reach up to 55,000 by the year end. So therefore, one, we have expanded our reach in the villages, and two, we have introduced low unit packs which are more affordable for the rural market, and therefore in spite of the fact that overall there has been a decline or a pressure on the rural expansion, we have seen better growth compared to urban. As far as urban is concerned, the growth is coming on account of modern trade as well as on the e-commerce, which is growing faster compared to the general trade. But when we compare urban versus rural, certainly rural is ahead of urban even in quarter 3 for us.
Growth, sir, which has been posted, is it as a result of down trading as well? As you've mentioned, you've introduced smaller packets in the rural market. Is it a result of that?
There are two aspects to this. Number one is the affordability, which is right, that the low unit packs are more affordable to the rural markets, and therefore they are doing it. And second is also liquidity crunch that we have seen in the rural market on account of uneven rainfall, on account of locust attack, etc. So there are both the aspects there where the purchasing power in the hands of rural market is comparatively lower, and that's where the low unit packs make it affordable for them rather than buying in bulk. They can come back in a low frequency and in a short frequency, and they can buy smaller units. So that is becoming affordable for them, and that is where we are getting the advantage.
Okay, so largely the top line growth that we have seen has come in because of the volume growth of 5 to 5.6%, which has been posted. In terms of pricing, now last quarter was also a quarter where a lot of these companies were giving discounts. There were a lot of offers, considering it was also a festive season. How did the pricing pan out for you? And also going ahead, is there any outlook that you can share with us?
Well, what we saw till quarter 3, there were deflationary benefits in terms of our material costs. So therefore, in the last quarter, we have not increased price per se. Though when we compare to the previous year, there has been some select price increases for which there was some positive that we saw in this quarter. But having said that, I think if we look at our ad-pro expenses, we have invested more compared to our top line growth into the ad-pro expenses, whereby we have gained as a market share, and that is going to be our strategy also, that wherever we are able to gain in terms of margins, we will continue to keep investing into the ad pro, so that we are able to reach out to wider customers and increase our top line.
A word on your foods business, where profitability is actually lower on both sequential and year-on-year basis.
Yeah, as far as food is concerned, we have seen there is a pressure on the top line, and we have declined compared to last year. So certainly there has been a pressure on the margins on account of low top line growth. At the same time, there has been product mix which has also adversely impacted us as far as the margin is concerned. That is one on account of Diwali gift pack, where since the Diwali was in this quarter, Diwali gift packs generally have a lower margin in view of the packaging cost, etc. And also we have gained in terms of the food drinks, where the margins are comparatively lower. So there is a mixed impact also, but primarily on account of low volume growth on juice, which has resulted in our margins. However, our efforts are to come out with the premium products also, and gain the market share so that our volume goes up and we are able to come back with the margins.
Okay, Mr. Malik, one final question really. A small conundrum for the next 6 to 9 odd months. If indeed food price inflation perks up, which would essentially mean arguably more hands in the money of the farmer, would that augur well for you, or because of the raw material cost inflation it would be a difficult thing to navigate through? I mean, food and rural inflation essentially.
Well, I think sure. See, I think inflation to some extent is always positive because it boosts the demand in terms of the purchasing power in the hands of the consumer. However, it has to be seen in terms of the synergies one can drive so that the cost disadvantage is not passed on in the form of price increase, because then the benefit will get wiped out. So therefore, I would say to some extent inflation coming in the rural market will help to boost the demand, but it has to be within the affordable limits so that it can accelerate the demand, and through synergies one is able to continue to provide the products at the similar price without increasing the price, which can affect adversely to the pockets of the rural market.
Mr. Malik, before we let you go, what's the guidance that you can share with us with regard to volume growth for FY21?
Well, as far as our current year is concerned, I think we have always maintained that for the financial year 1920, we will be closing the year by mid to high single digit volume growth, and we maintain for the current fiscal, which is 1920.
All right, Mr. Malik, we'll leave it at that. All the best for the quarters ahead, and all the best with the market share gains as well.
Thank you very much.
Well, that's the CFO of Dabur India. The stock has come off a little bit. By the way, some numbers on your screen. So while Dabur is one thing and 2.5% lower, it's just been a very heavy news-heavy show. IOC number is up on your screen as well. The net profit up at 2339. This is largely in line, maybe marginally off from the levels that the Bloomberg poll was estimating, and EBITDA versus an estimate of 6468 is at 6650. So that too largely, I mean, it can maybe marginally higher than what the numbers were. And look at that, the margins too, 5.34 versus 5.2. Not a big needle moving set of numbers from Indian Oil Corporation. Not that it was anticipated, but nevertheless just a steady state number, about 1.2%. The stock correcting right now. I think Sumit Sarkar is what I would probably want a view from Jigar as well on this one, but or the OMC space at large. But let's first get in Sumit Sarkar because he tracks this very, very closely. Just give us a small detail of what else is he reading. Maybe Sumit has got the access to the press release as well and some other details. Sumit, good afternoon. What are you making of these numbers?
Well, the numbers are pretty much in line with what the analysts were expecting. Now, if you see the revenues of the company, they have come in at 12% higher, at close to 1,24,600 crore rupees. The EBITDA number has come in 86% higher, at close to 6,650. Now, analysts were expecting this number to be close to 6,450 crore rupees, but this is slightly ahead of what analysts were expecting, and that is mainly on the back of a strong performance coming in from the petrochemical division of Indian Oil Corporation. Now, if you see the petrochemical division's EBIT, now that has come in at 513 crore rupees as against 494 crore rupees last quarter. Now, analysts were expecting a decline in the petrochemical business because of weak product spreads, but the numbers have come in ahead, and that's the key positive number that has come in for Indian Oil Corporation. We are still waiting for the GRM numbers to come in, and that will come in at the presser, which is at around 3:30, and there was no press release so far, so we are still to get in the details of inventory loss and inventory gain that the company has incurred in this quarter. But that should be in line with what the analysts were expecting, because overall the numbers have come pretty much in line. Analysts were expecting the inventory profit to be close to 1,300 to 1,800 crore rupees, so that's the number that we are keeping an eye out for. Along with this, we also have to watch out for what the GRM number is for Indian Oil Corporation in the third quarter. Now, on the bottom line front, the company's net profit has come in around 2,300, while the EBITDA margins have come in better at 5.3% compared to 5.2% last year. So overall, the numbers are pretty much in line with what the analysts were expecting, but we still have to wait out and watch out for the inventory gain number, the gross refining margin number, and the debt number of Indian Oil Corporation in the presser.
The 9-month GRMs are at $3.4 per barrel, and there's a forex loss of about 181 crore, which has been reported, Neeraj.
Yeah, well, I know Mayuresh tracks this closely, but let me just take a quick check with Jigar if he looks at these numbers on these companies at all.
Not really.
Not really.
I don't really think this is an interesting space to be in. Oil per se is not something that we think is going to move a lot. OMCs have already moved a lot, so we might as well just hand it to the expert.
Yeah. No, well, I presume that he does, but I would want to ask you some final thoughts as well. But Marish, quick initial thoughts on IOC, if any.
So in line, Neeraj, very frankly, and what happens with the petchem business is it moves in tandem with how crude moves. So if crude largely moves downwards, right, the downstream products, which is largely petchem in nature, are going to move downwards as well. So there is going to be an inherent pressure in terms of both demand dynamics and the realizations on that one as well. The second element obviously is with the new IMO regulations coming in, I think the middle distillate players are going to benefit significantly compared to the ones who are having a lower distillate market share. So the Paradeep refinery is doing exceptionally well in terms of the Nelson complexity. The middle distillate portfolio is also quite well stacked up. But as Navneet was pointing out, I think the gross, the GRMs, I think they probably remain in this range for some years. I think better sectors or stocks to probably look at.
For sure. Well, a lot of people would say that. Though, maybe the commentary might differ for BPCL because there is an added element out there. Well, let's wait and watch. Okay. So, Jigar, one final thought. You mentioned about a lot of things that you, different, your portfolio. I heard you mention that your portfolio is constructed with a slight bit of a difference. Let me ask you, does the portfolio have any presence of some of the pockets where the market expects some significant measures, which is real estate or infrastructure? Do you have exposure here?
Absolutely.
Where and why?
See, real estate is one sector which doesn't cost the fisc too much, and the government can possibly bring a lot of sort of positive surprise to it. Imagine they come and say that, okay, you buy a house, any value, and you don't pay taxes, buy a house for the next 12 months and don't pay taxes on it ever, right? Something like that. Realty index per se is up 40% last year. So I doubt if there are any direct plays, but there are a lot of indirect plays in terms of NBFCs that are very interesting. We own PNB Housing. Mahindra Financial Services is very interesting from the rural recovery standpoint. So yeah, those places in the real estate space are very interesting.
Right. Good talking to you, Jigar. Thanks so much for taking the time out and being with us today.
Thank you for inviting me.
Our pleasure is ours. Well, that's a view from Buoyant Capital on select pockets. As we speak, though, when I look at what's happening beyond, the markets have just recovered a little bit from the levels that they were trading at just about half an hour ago. So we are off the lows of the day. Keep that at the back of your mind. What's moving?